100% bonus depreciation is back, and most investors and high W-2 income earners have no idea what that means for their 2025 taxes. Today, and this topic could easily save you 5 or 6 figures on your 2025 tax return legally, and yet most investors or high W-2 income earners have no idea that it's back on the table. Here's what we're talking about: bonus depreciation, cost segregation studies, and make sure that you stick around to the end, because I'm going to walk you through a real life case study, show you how to make this strategy work even if you're not a full-time investor. And I'll also point you to some videos that go deeper if you're really serious about cutting your tax bill. Hey there, and welcome back to the Wealth Planning Podcast with Birster Law. I'm Anthony Brister, tax attorney, a business owner, and someone who's been in the trenches with real estate investors, business owners, and high income earners, helping them create and keep more of their hard-earned money. First, let's go into bonus depreciation, but we got to get clear on the basics. So when you buy a property or an asset for business use, you don't get to write off that full amount right away. The IRS makes you depreciate it or spread up that cost over a certain amount of years. So for real estate, that's 27 and a half years for residential properties and 39 years if it's a commercial property. That's a long time. But in 2017, the Tax Cuts and Jobs Act introduced 100% bonus depreciation, which allowed you to write off certain property, mainly 5, 7, and 15-year assets, all in the first year. And that's huge. Think about it. If you buy $100,000 of furniture, fixtures, and equipment, you could write off that whole $100,000 this year instead of waiting 5, 7, 15 years. Now, it's supposed to phase out 80% in 2023, 60% 2024, and 40% this year in 2025, eventually down to zero. But the big, beautiful bill that was just signed into law by President Trump on July 4th reinstates 100% bonus depreciation retroactively through January 19th, 2025, and it extends it into the future permanently. This changes everything for real estate investors, especially if you know how to pair it with a cost segregation study. Now let's talk about the real power play. A cost segregation study is a specialized study. It's typically done by an engineer or a cost seg firm, and it breaks your building into its different structural components, because not everything in a house lasts 27 and a half years, right? Cabinets wear out sooner, your carpets wear out, HVAC systems go out 10, 15 years. Your landscaping doesn't last 3 decades. But the IRS doesn't separate out those items unless you ask them to, and you do that through a cost seg study. And here's a trick. Once a building is broken down into these different structural components, the 5, 7, 15-year assets, you can apply that bonus depreciation to those parts. So instead of a $500,000 property giving you $18,000 a year in depreciation, a cost seg depreciation combo might give you $130,000, $160,000, even maybe $200,000 in year one. And that's a play. And that's why this is so powerful. You go from maybe getting the $18,000 deduction to 6-figure plus. And that's how you can gain and build real wealth through tax savings. So let me give you a few examples from real clients. First client, we've got the high income W-2 earner and the short-term rental combo. This is my favorite for you short-term or W-2 earners, because it's one of the few things you can do to actually offset your W-2 income. So I had a married couple that bought a $700,000 short-term rental in Tennessee. They both have a W-2 income combined of $410,000. We did a cost seg study that generated $185,000 in first year bonus depreciation. And because they documented over 100 hours of material participation and they materially participated more than anyone else, they were able to take that loss against their W-2 income. The end result, well, they saved over $73,000 in federal income taxes and got a big fat refund check. Another client, he was a dentist turned real estate investor. He was making over $300,000 in taxable income, and he owned a combination of long-term rentals and a short-term rental, but he had never done a cost segregation study. So we did a look-back study and filed Form 3115, which let him catch up all his missed depreciation without amending any of the past returns. He got a $48,000 deduction in the current year just by catching up on that depreciation that he was already entitled to. This is why I say if you bought a property in the last 5 to 7 years and you haven't done a cost seg study, you're likely missing out. Let me say something pretty boldly too. Most CPAs are too reactive. They're going to wait until tax season, plug in your numbers, and tell you what you owe. But that's not tax strategy. That's compliance work. And it's not their fault. They're overloaded. The industry is understaffed. And they're not trained in real estate specific planning. And they probably don't own real estate themselves. But if you're serious about wealth, you need to think like an investor and not a taxpayer. A taxpayer is at the end of the year, come April, they just ask, what do I owe? While an investor asks, how can I structure this to legally pay less taxes and grow more and buy more assets? If you want to figure this out, go to bristertaxlaw.com and schedule a discovery call with my team. Now let's move to a more advanced play for those of you who have multiple rental properties or rental properties that have been in service for a while. That's the partial asset disposition. Let's say you bought a property 2 years ago and you just did a renovation. You replaced the HVAC, the kitchen, the bathrooms. What most investors don't realize is that they're still depreciating those old assets even though you literally just threw them in the dumpster. But if you have a cost seg study and you actually have those items separately stated and depreciated, then you can write off any remaining value of those old assets in the year of the renovation. We helped one client dispose of a $14,000 HVAC that was still on their balance sheet. That's $14,000 off your taxable income and an extra HVAC off your balance sheet that you don't have to recapture when you sell. And again, all of this is legal and code-based. Here's where it gets even better though. When you combine the bonus depreciation and a cost seg study with the short-term rental loophole, it becomes one of the most powerful tools available for W-2 income earners. Remember, short-term rentals aren't subject to the passive activity loss rules if your average stay is less than under 7 days and you materially participate. And one big trap that I see is people having over 14 days of personal use. If you can avoid the personal use, materially participate, and have that average stay of 7 days or less, it can become big tax savings. So if you materially participate, say you spend 100 hours and more than anyone else, or maybe you have a few properties and you can spend 500 hours total, you can take that bonus depreciation and offset your W-2 income or other active business income. And this is huge. Do you want to know what qualifies or how to keep track of your material participation? Check out bristertaxlaw.com and ask for our advisory services. And here's what you do if you're serious about using this to your advantage. Go book a discovery call at bristertaxlaw.com. We'll look at your properties, your tax profile, and see if a cost seg study makes sense or filing a 3115 makes sense. Go subscribe to my YouTube channel. Go to youtube.com at Brister Law Firm. I post weekly videos on strategies to grow your wealth, the short-term rental loophole, cost seg studies, bonus depreciation, and how to understand your tax return like a pro. Get the study done before the end of the year, especially with 100% bonus back, because timing matters, and you must place this property into service before December 31 to take advantage of it this year. Most investors work hard, buy property, and they think they're doing everything right. But if you're not using bonus depreciation to your advantage, if you've never done a cost seg study, or if your CPA hasn't brought this up, you're probably overpaying, and the IRS isn't going to tell you. So let me leave you with this. The tax code favors those who actually take action. You don't need to be wealthy. You just need to plan like you are and take action. Well, that's it for today's episode on the Wealth Planning Podcast with Brister Law. We went over bonus depreciation, cost seg studies, and how to actually apply this to your real life. If you found this valuable, share it with a fellow investor. Hit subscribe so you never miss an episode, and visit bristertaxlaw.com to schedule a free discovery call. And don't forget to check out my related videos on our YouTube channel, where we dive deeper into topics that are going to help you keep and protect more of what you earn.